Good morning and welcome to this morning's Knowledge Bank. Today's webinar will be hosted by Ray Armand, and she is Managing Director of Qube Accountants. She's going to be discussing how to present service charge accounts that will wow your clients. If you have any questions throughout the webinar, please submit them via the Q&A button at the bottom of your screen, and we will try to get through as many as possible at the end. The webinar is also being recorded and will be available to watch back via our YouTube channel later today. I will now pass you over to Ray to begin the session.
Hi everyone, let me just get my screen shared here. So if I share screen one, there we go. Vicky, let me know if you can't see that. Vicky, I'll rely on you responding to let me know if you can't see it. Otherwise, I will crack on.
Yeah,
let me
just
just hide the floating. There we go. Okay. Thank you for taking the time in your busy schedules today, everyone, to join this webinar. So the idea of this webinar, as Vicky said, is to make managing agents aware of the potential pitfalls in preparing service charge accounts that don't meet the requirements of the RICS Service Charge Residential Management Code. So that's a bit of a mouthful. And so when you hear me refer to the code, I'll just use that going forward in this webinar. So that's the RICS Service Charge Residential Management Code, which I'll refer to as the code. And so the idea is to help you to prepare your service charge in line with that, but also give you some best practice tips. So if you're on this webinar, I know that you're probably the kind of person who wants to be a world-class property manager, but the problem you probably face, sorry, just seeing here, the problem that you probably face is that you are frustrated by the quality of the financial information that you are able to present to your clients at the AGMs, or and get poor feedback from them, and you're just kind of going in circles and you're not sure how to improve that sort of relationship or that information flow that's going to your clients. I believe that good quality financial information should be a given and not just a nice to have. I am passionate about the property industry, and I work very closely with a few managing agents and property owners to ensure that the financial aspects of property management are compliant with the rules and regulations. So that's what we do. And in doing this, I must say, I am amazed at the number of managing agents that I come across who have simply not been advised by their accountants how to prepare service charge accounts in line with the requirements of the lease. For example, if the lease suggests a specific treatment of a reserve fund, or says that the service charge accounts need to be independently reviewed, or there's just certain requirements we'll be going through in this webinar. It's just really scary how often the accountant hasn't sort of supported or advised the managing agent in identifying those requirements. So my goal is to take away the pain from completing service charge accounts by providing you hopefully with some accurate, easy to digest information so you can focus on what you guys do best, which is doing your world-class property management. So by way of background, just a bit about me, I am a chartered accountant with ICAEW, which is the Institute of Chartered Accountants in England and Wales. I have a master's degree in finance, and sort of my working background is I started out at the world's largest accountancy firm, PricewaterhouseCoopers, before moving to Deloitte in London. I am now a partner at Qube Accountants based in Exeter, Devon, as Vicky said, and we specialize in service charge accounts. So let's begin by saying, who is this webinar for? Where the property is managed by agents of the members of the Royal Institution, the Royal Institution of Chartered Surveyors, RICS, or the Association of Residential Managing Agents, ARMA, which I'm sure you're familiar with. The rules of those bodies require members to adhere to the following practice, which I'm going to be taking you through, which is based on the code, as I mentioned, the RICS Residential Management Code. However, it is important to note that the provisions of the code do also apply more widely than just to professional agents. All the requirements in the code are upon the manager. So they use this term, the manager, who may be a landlord, a managing agent, a residence management company, or a right to manage company. So anyone who is managing the service charges is sort of encapsulated in the requirements of the code. Okay, and as I go along through this webinar, if there's anything that I'm talking about and you have additional questions, obviously please do post them in the comments and we will get to them at the end or in the Q&A box. Okay, so that's who the webinar applies to. What will we be covering? Well, the Institute of Chartered Accountants, as I mentioned, RCAW, in conjunction with ARMA and RICS, so all those bodies got together and they released a technical guidance, and you may have heard of it before. It's called Tech 311, and that outlines best practices for accounting and reporting in relation to service charge accounts for residential properties. So what I'm going to be doing is taking you through some key points from this technical release, but also sharing some best practice tips. So what I've done to sort of make this sort of in a easy to digest format is I have put together some 7 common mistakes that I see, or that my team sees, in preparing service charge accounts and working with managing agents. So let's go through those now. Okay, mistake number 1 is not checking the requirements of the lease. So it's I see it so often that people are just kind of, they might have skimmed through the lease previously, they don't have notes on it, and there'll be some sort of requirements hidden within the depths of the lease that are not being complied with. So if the lease or tenancy agreement sets out the way in which service charges are to be accounted for, like for example, who shall certify or approve the accounts, the costs that can be recovered, or the periods of time for which the accounts should be prepared, then the requirements of the lease must be followed. The primary driver for the operation of the variable service charges is the lease, which is a legally binding contract between the leaseholder and lessee and the landlord or lessor, and if applicable, a third party such as the resident management company, which is what we typically see. It is essential that the requirements of the lease which dictate the service charge accounts and costs are accounted for. So there's obviously a whole lot of sections of the lease when you're looking through the transfer document or the lease that aren't going to be relevant, but there often is, like on Schedule 4 or 5, there'll be a few paragraphs, maybe a bit more, that dictate the requirements of how the service charges should be handled, and it's important that those are read and understood and complied with. This is because lessees can challenge the reasonableness and payability of service charges at leasehold valuation tribunals. One established reason, and this is a common one, for tribunals to decide whether or not the service charges are payable is whether or not the accounts conform with the requirements of the lease. So it can be one silly point that you don't comply with, like, for example, you need a certain person to have signed off on the balance sheet, and if that's not complied with, then there may be an issue in recovering the service charges. If the lease requires, for example, like I've just said, a certificate by the landlord, the landlord's agent, the landlord's accountant, or even the surveyor to accompany the service charges, and this is not what's done, then it could be an issue. So if the lease requires it, it must be done. Many leases contain requirements for service charge accounts to be prepared for each year and be audited. So this is another thing that you may be aware of or have come across in your sort of practice, is that you see that the accounts, there's a requirement within the lease that's audited, or maybe you haven't read through the lease, and following this webinar, you have a detailed read through and you notice that there's a requirement for audit. Okay, I'm going to be delving more into that now. If the lease does not specify that an audit is to be undertaken, so let's say it's silent, this audit is not mentioned, or if the landlord has construed the lease as allowing a form of engagement other than an audit, so there's a way of sort of looking through it and there's nothing that says an audit has to be done, then what Tech 311, which is that paper, that technical paper that I said was put together by all the regulatory bodies, Tech 311 suggests that the best practice is to conduct a report of factual findings on the service charge account. So that's what you're going to see in most cases, is a report of factual findings. Therefore, like I said, if no form of examination is specified in the lease, so it's silent, the normal arrangement is to engage an accountant to make a report of factual findings. But a common question I get is, what if the lease says an audit is required, but you as the managing agent or the property owners do not want an audit? What are our options in that case? Okay, so the question we often get is, can we get around having an audit even if the lease states that an audit is required? Well, Tech 311 gives 2 circumstances in which it is possible to avoid having your service charge accounts being audited, even if the lease states that an audit is required. Okay, so let's go through those. The first is if the lease itself is dated before 1980, so the year 1980, then an audit is not required. The reason for this is that the lease predates the ISA, so ISA. That is the International Standards of Auditing. Okay, so if the word audit is used in a lease predating 1980, that lease was before the international standards of auditing were prepared. So the terminology governing annual statements of accounts, particularly in older leases, may be quite general. And so maybe they may have used that audit term loosely. And auditing standards and practices have changed fundamentally since the Auditing Practices Committee was established in 1976, which led to the publication of the first sort of standards and guidance around auditing in April 1980. So that's why we talk about before 1980, that term audit was used very loosely, and the work effort required by current auditing standards is unlikely to be what was anticipated when older leases were drawn up. Okay, so that's how we can conclude that. So pre-1980 leases, if they use the word audit, you almost certainly don't have to default to an audit. In practice, therefore, as I said, there is scope for the landlord to consider whether the terms in the lease may be construed according to the meaning given to those terms. So should you take that literally as an audit, or was it before the term audit was clearly defined? Okay. So let's talk about then the second scenario. So the first is if the lease predates 1980, you can avoid an audit. However, if you see a lease and it's after 1980, the date of the lease, and it has the word audit, what are your options? Well, there is one other scenario. If the costs to carry out an audit are disproportionate to the benefits obtained. Okay, so that's the wording in Tech 311. So if the costs to carry out the audit are disproportionate to the benefits obtained, and so what is considered disproportionate in this matter is a matter of judgment. So it does require judgment, although Tech 311 does give an example of a small property where the lessees are all members of the resident management company for the property. So if you have a very small scenario where all your lessees are members of the resident management company, so like directors, and they're all very hands-on, then you could say, oh, well, an audit isn't really required because they sort of have hands-on and understand all the detail going through the accounts. So it is a matter of judgment, and let's kind of just sort of flesh that out a bit. Okay, so the circumstances when the disproportionate argument can be justified would seem quite limited. They are quite limited. If you look at that, we're just looking at the example that Tech 311 gives is a very small property, okay, with only a few flats or a few houses. Okay, so the follow-on question that I often get then is, well, what if it's a different, like it's not necessarily as easy to say we can wholeheartedly conclude that it's disproportionate, but we all agree that we don't want our service charges accounts to be audited. Surely if everyone is on the same page, that we shouldn't have to. So perhaps, for example, the resident management company directors claim that they have agreed and minuted in a board meeting, so they have board minutes, that they wish to dispense with an audit. They don't want an audit to take place. Even if all lessees unanimously agree to this course of action, it is still unfortunately not a watertight option. The only sure way of a resident management company directors to do this and avoid criticism at some stage in the future is to vary the terms of the lease and to change the term audit that's used in the lease, so audit the accounts, to something like certify the accounts, something similar. You have to get rid of that word audit. So that's the only way you're going to do it, is to vary the terms of the lease. This course of action is not always popular, as varying a lease can result in a significant cost to lessees, and it may be many years before the savings of audit fees outweigh the legal costs of varying the lease. So it's a bit of a tricky one if you are sitting in a scenario where it's not very obvious that the cost of the audit outweighs the benefit, or if it's an older lease, so a newer lease. If you just don't have either of those scenarios I spoke about, it can be quite tricky. So an audit report on service charge accounts should not be dismissed without due consideration, because it could really cause issues in the future. In most circumstances, the additional assurance provided by an audit will warrant the additional cost of an audit being carried out, except in very limited scenarios. So do keep in mind, though, whatever report is attached to the service charge accounts, the quality of the work will be enhanced if the reporting accountants are I'm going to talk about the regulatory bodies that it should be covered by, or if they are experienced in doing service charge accounts versus a general accountant. The quality of work will make a difference, and that can also help you out if you have concluded to do not do an audit. If you have people who specialize in service charge accounts, then they're more likely to be able to follow the exact requirements of Tech 311. So that's audit. Mistake number 2 that I want to talk about is not using a ring-fenced designated bank account to hold the funds. So the code, again, that's your RICS code, sets out the best practice. Part 10.8 of the code states that service charge funds for each property should be identifiable and either placed in a separate bank account or in a single client trust account where the accounting records can separately identify the funds attributable to each property. So let's break that down. So you either need to have a separate bank account, or if you are kind of putting it all into one bank account, you need to make sure that your accounting records are robust, that your software can handle you very clearly and confidently being able to identify which funds in that kind of combined bank account are attributable to each property. It is therefore, well, I would say it's best practice for landlords or the agents to open a separate bank account for each property or development, because that's just your surefire way. That bank account should have the word trust or client in the name of the property in its titles. Okay, landlords and agents should note that it is a breach of trust to use funds from one property to ease the cash flows of another. So it may be very tempting if you know, oh, I need to use the funds. I have this money sitting, that, you know, these properties have a lot of funds sitting there. Let me just use it because we really, really need to pay for this roof replacement. And we will then, as soon as possible, collect those service charge funds from the current property owners and then get those funds transferred across. Like, I mean, hopefully I'm teaching you to suck extra, but that is absolutely should never be done. So definitely avoid that under all circumstances. So opening separate bank accounts for each property is the best way to prevent misuse of service charge money. So that is what I would recommend, rather than having it all mush into one. And with the way that sort of banks have advanced over the years, they make it so easy to open up separate bank accounts for each of those your companies that you're working with. So to rather just sort of commit to doing that than having it all mush into one and relying on the software, that's kind of the secondary sort of option. So I just want to end by saying there is no requirement in the code to open a separate bank account, but it's best practice. And then the other sort of thing I want to touch on is around reserve funds. So normally what you have is you would have one bank account for each property, but the question we sometimes get is, should we be opening a separate bank account for the reserve funds if we are building up a reserve fund for each property? Now, there's no requirement in the code for that either. So you don't need to do it unless the lease specifically requires. Okay, mistake number 3 that I want to touch on is not using the software you have to its full potential. So I generally see that managing agents are using good pieces of software, but they're often not using it to its full potential, or at the last hurdle, they've used it well all year, but they just don't extract the right reports from the software. And that's also a very common mistake I see. So let's go through this. Under the Landlord and Tenant Act 1985, the landlord is responsible for the preparation of the service charge statement in respects of the cost of the property. So the responsibility for the preparation of the service charge accounts is the landlord, which then falls to the managing agent. This means that the appointed managing agent is responsible for preparing the service charge accounts and ensuring that the financial management of the service charges is sound and that there's an effective system of internal control which ensures the proper use of the service charges. What often happens in practice, though, is, of course, managing agents do sometimes provide the list of transactions for the accountants to prepare, but you must keep in mind that the obligation does fall onto the managing agent. So it is your responsibility, if you're the managing agent, to make sure that you keep proper records, you have sound internal controls, and make sure that those funds are properly looked after. A common issue I see is that the managing agents assume that because they are using a good piece of software for their block management, that the block finances are under control. However, simply using one of these really good, robust pieces of software is not indicative of an effective finance function. You still need to put in place robust processes that are mapped out to support your software. So processes would be things like making sure that you, with your bookkeeping, so keeping track of the transactions, that's done maybe minimum on a weekly basis, so or whatever you think is reasonable, monthly, weekly, but you have that mapped out. You say, right, bookkeeping, or recording transactions, this must be done weekly. Here's a checklist. I create like a process would be just creating a checklist for your admin staff to go through, like have they attach a piece of evidence, like a piece of paperwork to every transaction? Have they checked that everything, if once the banks are reconciled, have they checked that the bank balance agrees to your bank statement? So you need robust processes and checklists to ensure that in conjunction with using that software, that you have strong controls around your service charges. Okay, so standard operating procedures or processes are key to ensuring that an effective system of control is around your service charge monies. It's important to keep in mind that bookkeeping, and I always bang on about this, but bookkeeping is the foundation on which all financial reporting rests. So I'm sure you've heard the age-old saying, garbage in, garbage out. So it is essential that the bookkeeping is done well to ensure that good quality service charge accounts can be produced. So if it's not done well day to day, you're not going to have, no matter which accountant you work with or no matter how you prepare those service charge accounts, if it just doesn't make sense, if the bookkeeping if things haven't been categorized properly, etc., you're not going to have useful information to present to your clients. So if it's important to them to know what's been spent on lift maintenance, make sure that cost is separately itemized in your bookkeeping so that it can be then separately itemized on the service charge accounts. Okay, so bits of information that are captured in a certain way will impact how then they're able to be reported on the service charge accounts. Okay, and then at the end of the reporting period, it is essential to run reports that are useful in preparing service charge statements. Now, this may sound obvious, but we have taken on new clients where the previous accountant was provided with the wrong reports, or reports, these 40, 50 page long PDF reports that have been extracted from the documents, and the accountant is now expected to pull together a set of service charge statements when they haven't been provided the reports in an Excel format, or they've been provided with reports on the cash basis and there's no accrual information, etc. And this leads to a lot of frustration, not just with either with the accountant feeling frustrated, or the work gets handed over to someone on their team and they just crack on with what information they have. And I've seen this. What then happens is the set of service charge accounts, so your income statement and or your profit and loss and your balance sheet that comes out at the end, because the right reports weren't extracted, that end report that is then prepared by the accountant makes no sense. The figures don't tie up. You can't track, where the figures come from. And so you actually end up with a nonsensical set of information. Now, that all comes from, you've done everything correct up to that point. You've just extracted the wrong reports from your software. So also make sure that you're looking what reports are available and you're considering and carefully extracting the right information from that software in a useful format for the accountants to work with, because it seems obvious, but it does actually make a big difference when it comes to the practical side of things. Mistake number 4 that we see is not completing the accounts in a timely manner. I'm sure you all know this one. This might be a fairly obvious one, but I did want to point it out because it's important just as a reminder. So current legislation, so if you look at any of those sort of technical releases or the code or anything, nothing there states how soon the annual statements of accounts for service charges should be produced and issued to leaseholders. So there's nothing out there that specifies exactly that. So there's nothing that says how soon after year end these should be completed. There may be a date in the lease or a statement that states that the information should be produced as soon as practical. However, landlords and agents need to be aware of Section 20B of the Landlord and Tenant Act 1985, which sets limits on the recovery of expenditure on services incurred more than 18 months before the relevant costs are demanded from the lessees. Okay, so that can impact, because where the tenant requests a summary of costs in accordance with Section 21 of the Landlord and Tenant Act, the landlord must provide the summary within 1 month of the request or within 6 months of the end of the accounting period in question, whichever is the later. So if you're beyond that 6 months after your period end, you can see this is going to cause a problem. If the tenant is requesting details on the cost, the later of the 6 months after the end of the accounting period, and you don't have that information, it's a problem. It is therefore best practice to issue your service charge statements within 6 months of your accounting year end. Okay, so the lease will possibly dictate what year your resident management company should have, so what the year end should be. If it doesn't, you've obviously selected a year end, like 30th of June, and it's important that that is done. It's best practice to get your service charge statements out to all your tenants within 6 months of the end of that financial period. Otherwise, you may have issues around the recoverability of those costs. Okay, as I said, if you have any questions on this, do post them in the Q&A and we can obviously delve more into them at the end of this. The fifth mistake I wanted to go through is not presenting the information correctly or in an easy to understand format. So there is no recognized accounting framework for the service charge statement. So there's no particular framework. What that Tech 311 or that technical guidance that RCAW released in conjunction with RICS and ARMA said is in that guidance, they tried to sort of put together some format or recommendation for how these should look so that it became a bit more standardized, because before the technical release, it was all over the place. So Tech 311 guidance recommends that service charge accounts are prepared on the accrual basis. So in accounting, you get the cash basis or you get the accrual basis. In most cases, the lease is silent on what basis they expect you to prepare. So Tech 311 recommends that service charge accounts are prepared on the accrual basis, and that accounts should include a balance sheet for the service charge funds, so you can see what the balance is on those service charge funds, as well as an income and expenditure account with explanatory notes. Okay, so that's Tech 311 said this is what should be included as a minimum, and it then does also give some illustrative examples of what those should look like. I do have, which I'll provide you at the end of this webinar, with a link to get hold of our sort of guide that shows you, sort of runs you through pretty much everything I've gone through in this webinar. And at the end of that guide, I have screenshots or like sort of images of what Tech 311 suggests your service charge accounts should look like. And that kind of gives you a base format for what you should be sort of using as your template or structure for what those service charge statements should look like. So as a minimum, where service charge monies are held on trust, the records must be capable of showing, so this is at minimum, or stipulate the amount held at the bank for the individual property or service charges. So we've obviously already touched on this, but the service charge statement, where you are, whether you're holding a separate bank account or you're holding in one and getting your software to track what the balance is, it is important that the service charge statement shows on the balance sheet exactly what is held for each of those properties. And it also needs to clearly show the amounts demanded and paid in advance by or due from each lessee. So the service charge statements need to be able to clearly show what is the actual balance of the bank balance or the cash balance for that property, and clearly show if there are any overdue or paid in advance service charges for each lessee. Okay, so that's very important that it shows that, and that you can understand is understandably important, because when you're sitting down at the AGM and actually going through what's happened with those service charges in the year, you need those figures at hand to be able to discuss them with the lessees. The service charge statement will always need to include also details of the costs incurred in the accounting period in relation to the property in accordance with the lease. Okay, so that's fairly obvious. So you've got the balance sheet, I've said, is showing you the balance of the funds, your cash balance, and what needs to be still needs to be paid in terms of service charges or what have been paid in advance. But then moving on to your profit and loss, you also need to be able to clearly show what are all the costs itemized in terms of what were those service charges spent on. And of course, I've said already, there needs to be explanatory notes where any figures sort of need more of an explanation behind them. So if there's any figures in those service charge statements where more of an explanation is needed, it's important that someone can look at this information and actually understand what is happening. So don't lose sight of that. So even me like running through and rattling off all the requirements, we can get lost in the detail. And I could, rattle on and on about all the different things that it should include. But the key thing to note is that the information should be in a format, also have a certain level of detail that the leaseholders or members of the company find most useful. At the end of the day, the information is being prepared for them to be able to sort of see the story or be able to actually see what happened with those funds. So it's important when you're looking through that if they are requesting certain information from like the previous year's AGM, or if you are looking at that and you think, oh, I really need to be able to show them this specific figure, it's important that you make sure that that's there so that it facilitates that useful conversation and that useful understanding of what has happened with those service charge monies. I also want to see if there's anything else I wanted to say here. Yeah, so basically, yeah, the best way for without me rattling off all the different best practice things is to have a look at that template or that sort of ideal set of service charge accounts to see what it should include. And are you going to see, I'm going to touch on shortly, it is also best that your service charge accounts are separate from your accounts that are submitted to Companies House. So if possible, you should have your set that gets submitted to Companies House, and then you have your service charge accounts, because they're trying to achieve completely different objectives. Your accounts that go to Companies House are ticking the requirements of FRS 105 or 102.1a, completely different sort of requirements than what is required to be useful to your lessees or your your property owners. So there's completely different objectives that those two are trying to achieve. So when you try and then say, well, I'm just going to prepare one set of statements, you kind of just end up with something in between that doesn't quite meet the requirements of what is actually needed for those service charge statements. So it is best to have a separate set of accounts that go to Companies House to your service charge accounts. So have a look at those outlined ones from the Tech 311, because it's really useful to see what should be included. And obviously, as a minimum, we want to see an income and expenditure statement or a profit and loss account showing exactly what was spent each year with what those service charge accounts were used for. And then you want to see a balance sheet which shows you the balance of your reserve funds and the balance of any outstanding service charges. So mistake number 6 that we often, well, this one isn't as often, I think most people are aware, but just to again highlight this too, is not getting an independent review of the service charge accounts. So the code does state that all annual statements of accounts, so your service charge accounts, should be subject to an examination by an independent accountant before issue to the lessee. So if you have a more than capable internal team who are doing the bookkeeping and can prepare those service charge statements, that's great. And that's not to say that those service charge statements aren't perfect, but there is a requirement in the code that says you need an independent accountant to actually do the report of factual findings so that you can give the lessees the assurance that you as the managing agent who's involved in the day-to-day of dealing with those funds and paying the tradespeople and doing all of that, there's an independent person coming in and just saying, right, we can see that the funds have all been used appropriately and the money is being managed well. So it is important that there's an independent accountant outside of your company who does that review. Accountants appointed to carry out the reporting engagements in accordance with Tech 311 must be members of the following recognized supervisory bodies. So the two requirements are there must be an independent accountant, and Tech 311 does say that they need to be members of one of the following bodies. So I'll just rattle those off. I probably should have listed them on the screen, but I'll just rattle them off here. So the first is the Association of Authorized Public Accountants. Then you get the Association of Chartered Certified Accountants, so ACCA is what you've probably heard of that before. Then you get RCAEW, which is the Institute of Chartered Accountants in England and Wales. Then you get the Institute of Chartered Accountants in Ireland and the Institute of Chartered Accountants in Scotland. So in summary, you're basically needing chartered accountants. So you can't have like an AAT qualified accountant. You need chartered accountants working on this in order to meet the requirements of the code. And my final mistake, and then there's a couple of other best practice bits I'm going to get to, but the final mistake I wanted to cover is forgetting to file accounts with Companies House and HMRC. So I've touched a little bit on this, but let's just go into some specific detail. So let's start with Companies House. If your service charge statement is prepared on behalf of a resident management company or a right to manage company, because you can also, it's not necessarily always through a company. In majority of cases, it is through a limited company. And where it is through a limited company, then there needs to be a separate statement separate to the service charge accounts, a set of annual accounts that are prepared, meeting the requirements of Companies House and filed with Companies House. So this is saying that often managing agents forget there is obviously the options to either do, you might do a set of accounts for Companies House using FRS 102 or 105, FRS 105. Ideally, what you want to see with resident management companies is if you're able to justify that the accounts, that the company is dormant, which you can in most cases, you should be able to file a set of dormant accounts to Companies House, which are then super easy and quick to do. So in most cases, you should be able to justify that you could do dormant accounts, and just don't forget to do those. So that needs to be done separately to your service charge accounts. That's best practice rather than having them all as one. As far as tax treatment goes, there was a bit of sort of uncertainty before the technical paper was released, and before sort of it was decided what should happen, because you essentially have a company that's getting service charges paid into it and it's paying for costs. So should those service charges be seen as income for the company, and therefore should corporation tax be paid? This was a question, okay? So should the company have to pay corporation tax on the fact that it's getting this income, and less the expenses, there might be a profit left over? Well, the code, so part 10.12 and to 10.14 of the code, deal with the corporation tax treatment of service charges. And what they concluded, and what's been agreed with HMRC, and HMRC has confirmed this, so long as the service charges and the trust are held in trust, so the terms of the trust are met, the receipt of the service charge payments will not give rise to any tax liabilities in the hands of the payee, which is the resident management company. So basically, what HMRC, in conjunction with like RICS and ARMA and ICAW, all concluded, and it's all been confirmed, is that the service charge monies, or that like service charge income that the company receives, is not actually seen as income in the hands of the company. It's held in trust to be used to pay the costs. So there is no corporation tax to be paid on the service charge monies. So therefore, what does that mean? In most cases, you are not going to have to do anything with HMRC. The company will be seen as dormant from HMRC's purposes, and you have two options really then. You can either file a dormant corporation tax return, or if HMRC has never been notified that the company is active, they won't expect anything. Otherwise, if they are expecting something from the company, and you know going forward you're going to file dormant accounts, you can notify HMRC that the company will be dormant going forward. So the ideal scenario is that HMRC has been notified that the company is dormant and there's nothing to file. If they haven't been notified they're dormant, you will have to submit a set of dormant corporation tax return with accounts to HMRC every year, which obviously feels like a waste of time when you can just let them know. So in most cases, because of this agreement between HMRC and RICS and ARMA and ICAW, you can assume that all the money coming into the resident management company is held in trust, and therefore there's no corporation tax payable, and the company is seen as dormant by HMRC. But do keep in mind two things, and those two things are interest on any, like if the bank account builds up a big balance and interest is earned on those service charge monies or the funds held, so interest income, and the second thing is ground rent. Okay, so let's go through each of those. Any investment income, so just interest income on the bank balance, accrued on the service charge trust fund, normally which would be bank interest, is chargeable at the standard rate of income tax. So any interest income earned, so it has to be material amount. Like if we're talking anything under like 10 or 20 pounds, that's irrelevant really, but any significant amount of money that is interest income that's earned becomes chargeable for corporation tax. But there is an exception that can help you here. Often with interest income, it is taxed at source. So where tax at the standard rate is deducted at source from the interest, and this is often done by the banks, for example, HMRC has indicated that they will not require a trust sort of tax return to be completed. So if you're dealing with an institution that pays you your interest income after deducting tax, then you can still avoid having to do the company tax return. So therefore, the best way to reduce all your administration or accountant's fee costs is to make sure that any interest income you receive has the tax deducted at source, and then the whole interest income issue isn't something you have to worry about. But just keep that in the back of your mind, and just to double check that if you do notice that the resident management company you're doing work for has significant interest income, make sure that it has been taxed at source. Otherwise, it could be an issue with HMRC. The second scenario I wanted to talk about was where your resident management company earns ground rent. Okay, because the ground rent is not part of your service charges, it is not subject to section 42 of the trust provision. So that it's that section 42 of the trust provisions which says the service charges are being held in trust for the benefit of just paying these costs. So the ground rent doesn't form part of that. So because it doesn't fall within the scope of that, it then falls within the scope of corporation tax. So if your resident management company earns ground rents, then it may have to do a corporation tax return. So to summarize everything I've said on the slide, with regards to what needs to be submitted to Companies House, that does need to be submitted to Companies House every year, regardless of whether the company is dormant or not. So even if you have a dormant company, you do need to submit an annual statement to Companies House showing that. Okay, with regards to HMRC, if the company is dormant, you don't need to submit anything to HMRC as long as you've notified them that the company is dormant, with the exception that while service charges are not seen as income for the company, beware of interest income unless it's taxed at source or ground rent. And if those sort of exist within the resident management company, then you may have to do an annual corporation tax return to HMRC. So hopefully that's nice and clear for you. What I then wanted to touch on is your accruals, sinking funds, and reserve funds. So often it is, of course, desirable to spread the cost of major works over a number of years. So if you're in a block of flats or dealing with a block of flats and there's a roof to be replaced, or the cladding with the Grenfell fires, etc. If there's something that you want to not have to suddenly say, right, property owners, here's a huge bill, it's obviously desirable to spread that over a period of years so it's not this big shock. But interestingly, if the lease does not permit a reserve fund, it's not necessarily correct to just move over a surplus to create a reserve fund. The principle, and this is because the principle of service charge accounts is to equalize the cash that is demanded to the cash that is spent. So under that principle, you can't just go automatically building up a reserve fund or a sinking fund unless it's required by the lease. So accruing for major works not yet done is not an option unless the lease requires it. If your block needs a reserve fund and does not have one, then you will possibly need to look at varying the lease. How you do this is if you get 75% of the owners willing and not more than 10% objecting, then you can achieve this by seeking an order from the tribunal under Section 37 of the Landlord and Tenant Act, or the 1987 Landlord and Tenant Act, okay? Without a reserve or sinking fund, a block will suffer huge fluctuations, understandably, in the service charge levels that are demanded each year as the works are carried out. So the effect of the lease, which allows a fund, what that does, which hopefully this is pretty logical, if the lease allows a fund to be built up, it just means that you have less fluctuations in the service charges that are demanded, which is obviously preferable. And any managing agent would like to achieve that so that they can be seen as doing a good job, because no one wants to get a shock at suddenly being demanded a huge service charge payment. And without a reserve, there's obviously 100% of the major works costs will be collected in that year. And the challenge with even raising, if you haven't been able to build up a reserve fund, you as the managing agent managing this resident management company also have a bit of a risk, because the challenge in raising this money has been frustrated by a bit of case law. So you got a case of Garside versus RFYC Limited. And basically the outcomes there was that service charges can be held as unreasonable if adequate notice is not given where the whole cost of major works is put into a single year's budget. So if you as the managing agent say, oh yeah, we're not able to build up a reserve fund because the lease doesn't allow it, there's this big roof repairs, so we're gonna have to charge it. So that's what has to be done. But there has been a case where it's been deemed unreasonable to, if you haven't given adequate notice, to just actually charge that on to the lessees or the property owners. So that causes a lot of frustration, because you've got that issue at hand now. So your hands are tied. In one case, you can't build up a reserve fund, but in the other case, if you don't carefully give adequate notice, you also can't then get those funds recovered from the property owner. So Also, another frustration is some leases are an arrears lease, which isn't as common, but in that case, the freeholder or the freehold entity has to fund the works up front and hope to recover them afterwards. So that's also a problem. So the system is a bit dysfunctional, and that Garside case makes it worse because effectively, the Garside case said that the definition of unreasonable in respect of service charge expenditure could include that the money is just demanded too quickly. So it's a bit of a tricky scenario. So what should you do as a managing agent to overcome this? Well, just a few things, okay? So the first is ensure on every service charge budget that you let the owners know that they should be making provisions or set aside monies for future work. So every time you present a budget to your property owners, put in there a provision of upcoming major works so that you are advising them and giving them adequate notice of money they should be putting aside. Okay. Also, if possible, include a reasoned reserved plan within every budget that shows what is being collected towards each cyclical expenditure item and when such works are planned. So if your budget allows, if your lease allows, make sure that you have a well-reasoned reserve plan. So you don't just say, oh, I'm going to take this amount and put it into reserve. Actually lay out your reserve plan. Like say, if the roof repairs are due in 10 years, you've worked out the estimated cost is this, you've spread it over this period, make sure it's well-reasoned and well-explained to the lessee so that you can always have that to fall back on, so they can't come back at you and say, oh, this is not reasonable, I'm not going to pay it under Garside. Okay. I just want to see if you need, so see if there's anything else I wanted to say here. You obviously, like I said, you have the option to modernize leases, or you can seek an order from the tribunal to alter your lease. And yeah, it's a tricky area to navigate, and hopefully, again, you would have your accountant working with you to help you to sort of navigate this landscape. So what I want to end off on saying, because we're on about the 45-minute mark, so we should have a couple more minutes and then it'll leave some time for questions at the end, is I just want to touch on the practical steps to take following this webinar to hopefully reduce your stress, to gain more time to focus on actually doing the work that you want to do best and not focusing on the financials, and to impress your clients. So the first thing I said there is just to take the time to read and summarize the lease. So don't just read it. It's actually really good to just create a quick summary of the lease, maybe with some screenshots, which will say, like, be your future friend, so that you have it there as a quick sort of access, a quick way of reading, and next year when you're trying to remind yourself that it's there and you don't have to read through the whole lease. So make a summary of the lease. It only needs to be done once, and then you'll have the rewards of that in the years to come. Of course, I would highly recommend opening up a separate bank account for each property rather than having it all mushed into one account that you're using your software to track, because there's always a risk of something going wrong there. So it's best to have a separate bank account for each property. The third point is review how you use your software. Make sure that you do have some robust sort of internal processes in place. So that's just as simple as putting some checklists in place, some standard sort of processes that you expect your admin staff to follow when they are sort of tracking the service charges. So make sure you review that software, and also just review the types of reports, run through all the reports you're able to pull from your software, because you may find some really useful reports. So normally when I look at a piece of software, I will go and I'll literally almost click on every report that's possible to run from that software, and make sure that I'm not missing a trick and finding some really powerful report that allows me to make my job easier or present more useful information or something. Because not only do these pieces of software have loads of reports, but usually they're continually being developed. So there's new reports and stuff being added the whole time. So look out for that. So continually review how you use your software and make sure you're getting the best out of it. Maybe, again, as a practical step, block that in for once a quarter. Put like an hour block to just review your software and make sure that you're getting the most out of it. The fourth point here there is to aim to complete your bookkeeping within 4 weeks of the year end. Now, I know you're busy and a lot happens, but it's incredible the amount of time you can save by actually just doing the bookkeeping and having everything ready on a timely basis. Because instead of, if you say don't have the right invoice from a certain supplier, if you're doing it 6 or 8 months later, to go back to that supplier and say, hey, I need that invoice from 9 months ago, or even 12 months ago, for some, earlier in the financial year, that's going to be a lot more difficult for them to find the information. It's going to be a much slower, clunkier process. If it's done sort of in real time, and you make sure that all the bookkeeping and everything is wrapped up within 4 weeks of the year end. All that knowledge is fresh. Everything's high up in people's inboxes. You then hand it over to the accountant to prepare the service charge accounts. It just makes things literally take, in some cases, half the amount of time. So try make it a standard internal process that you get everything wrapped up, ready for the service charge accounts to be prepared within the first month after the financial period ends. Then the fifth point is actually just ask your clients, ask at the AGMs, ask them what they would like to see when you present the service charge accounts. I imagine a lot of people just switch off because it's numbers, but actually just take a step back and say, what do you want to be able to know or be able to see from these service charge statements? What would you love to be able to know is being done with your money? And we can make that happen and have that discussion with them, and then hopefully be able to communicate that back if you're preparing those internally or with your accountants to make that a reality. And then, of course, obviously, I would say, but I really do feel like there's a lot of value in this, is look for an accountant who specializes in service charge accounts. Most accountants are generalists, which means they don't know the nitty gritty. And so it's a little bit like a GP. Okay, so it's fine if you only starting out and you have a few properties, you can go to a GP that can sort out most issues. But as you grow and you have more and more issues coming up and little nuances around like audits and sinking funds, the same way you would go to a specialist when you require like brain surgery or you have a certain size property portfolio, it really helps to have a specialist accountant who does service charge accounts. There are others out there, obviously, other than Qube. So, but I do highly recommend going to someone who specializes in service charge accounts, because what I generally find, having worked in general practice myself, is the service charge accounts work that needs to be done is actually really small pieces of work. You're talking a few £100 for a set of service charge accounts. When we as accountants do a set of limited company accounts for a trading company, we earn a minimum of £1,500 to do those set of accounts, going up to £3,000 or £4,000. Okay, so obviously on a trading company set of service charge, of company accounts, we can afford to put quite senior staff in a general practice. What I see happen so often in general practices with service charge accounts is that the work gets handed to quite junior members of staff because it's seen as straightforward, but it means, and that covers most scenarios, but it means that when you have any unusual nuances or tricky scenarios to deal with, you have quite junior staff dealing with it because it's not high value work for like in general practice, and they miss things or they make mistakes that just then cause big issues for you down the line. Whereas a specialist team, we or other specialist service charge accountants have a team who do this day in and day out, which means we're able to do things quicker. So it's saying that we've kind of really nailed our processes around this, so that we can justify having more senior people really focusing on this. And it's also because we do it day in and day out, we know what to look out for, and it really does make a big difference. I've seen it time and time again when we get handed accounts from an outgoing accountant who's a generalist. There's things they just haven't thought to look out for. Okay, so those are the practical steps. What I just want to end off by saying before we jump to any Q&A is if you kind of want to get more details on anything that I've covered in this webinar, we do have a guide. So you can either on your screen right now using your phone, scan that QR code with your phone and it'll take you to the page to download the free guide. Otherwise, I have put the link on the screen here. It's qubeaccountants.co.uk/free guide. Otherwise, if you have any thing you would like to email me about afterwards, you can email me at accounts@qubeaccountants.co.uk. So we have a centralized inbox for the team. So any email that comes there will be dealt with by myself or one of the team. That's basically kind of next steps or any information. But what I want to do now, I just want to see if I can exit, if I stop sharing, is have a look. I don't know, Vicky, if you can hear me, at the Q&A box. I'm just going to pull up the Q&A.
Yeah, I'm here, Ray, if necessary.
Hi. Yes. So in terms of Q&A, I was just looking at the inbox, well, not the inbox, at the Q&A. The only statement was from Ryan Smith. They're saying that bank interest has not been taxed at source for years now. Isn't all bank interest received gross, isn't £500 the threshold? Therefore, so you can, yes, in most cases, but you can get, like, there are some circumstances where banks, not banks, some institutions will actually take the tax out of the interest before they pay it across to you, especially smaller, like sort of if you investment portfolios and things. So yes, it's not common. That's why you would have to look at the specific scenario and work out whether the interest has been removed to then decide whether you're going to have to do a corporation tax return or not. So we reviewed on a scenario by scenario basis. Yeah. So in most cases, you might find that it hasn't been taxed at source. And so then you're going to have to do a corporation tax return for that resident management company. Any other questions before we kind of end off? I can see two. Anything in the chat box? No. Okay. Well, Vicky, I think, yeah, we can end off there.
Okay, lovely. Thank you very much. Yeah, I think that was great. It was really informative. Thanks very much for your time today, Ray. Thank you to everybody else who has joined us. We have a lot more webinars coming up over the next sort of few weeks and months. So if there's any that you would like to attend, you can have a look on the News on the Block website where you'll be able to register. I'll be sending out the slides later today and the recording of today's session, if anyone would like to see that. Otherwise, thank you very much, and I will see you all soon.
Thanks, everyone. Cheers.
Thank you. Have a good day.